For the 1%, 4% positive and 4 negatives. Budget both gives to and takes away from the very rich. Here's how and why. The name of the author is Neeru Ahuja, who is partner Deloitte India. The budget lowered taxes for middle classes as well as high net worth individuals, HNIs. Critics question the need to lower tax surcharge for HNIs, as arguably they can afford to pay. However, we must remember the growing trend of such individuals wanting or actively considering migration from high tax countries to settle in tax friendly jurisdictions, or at a minimum to invest capital overseas. According to a Henley survey, in 2002 alone, 8,000 HNIs gave up their Indian passports and migrated to destinations such as the US, UK, UAE, Canada, Australia, and Singapore for multiple reasons, high domestic tax rates probably being one of them. This context is important in understanding the budget's reduction of India's highest effective income tax rate for personal incomes above 5 crore rupees from 42.74% to 39% by reducing the high surcharge of 37% to 25%. But if this is the good news for HNIs in the budget, there are some not so pleasant surprises for them too. Surprises that unfolded in the fine print and that would increase cash outflow or tax burden for HNIs. First, to prevent misuse of deductions provided under sections 54 and 54F, these deal with exemption from long term capital gains tax through purchase of residential property. The amount eligible for exemption has been capped at 10 crore rupees. This may have implications on property transactions that are almost complete. HNIs will want to close such transactions before April 1. Second, there is a tax on maturity proceeds of insurance plans, excluding ULIPs, issued on or after 1 April 2023, where yearly premium is above 5 lakh rupees, except in cases where proceeds are received on the death of the insured person. Until now, these insurance policies were added to the tax free basket of investments. This change will make HNIs carefully review their investment portfolio in insurance policies soon. Third, starting July 1, foreign outward remittances under the liberalized remittance scheme, other than for education and medical purposes, and overseas tour packages will attract tax collection at source TCS of 20% as against the existing 5%. Although the high TCS can be recouped during tax assessment, it would lead to higher cash outflow at the time of the transaction. For a remittance of 30 lakh rupees for meeting expenses of a child studying abroad, one would have to pay 6 lakh rupees upfront as TCS in addition to the 30 lakh rupees. Similarly, any person planning an overseas holiday would be subject to additional outflow of 20% of the cost. These numbers seem quite high and would discourage foreign travel. Finally, capital gains on market linked debentures will now be taxed as short term capital gains, regular slab rates of 30% plus for HNIs, instead of lower rates as long term capital gains, even if they are held for a period exceeding 1 year. It is important to note that although this amendment shall be applicable from financial year 23 to 24 onwards, it will still have a retrospective effect to an extent, as it also applies to the market linked debentures held prior to April 1st, 2023. This announcement was highly unexpected considering HNIs are the most active investors in the market and their income is taxed at the highest applicable tax rate. This change shall compel HNIs to rethink their investment portfolios. So, while HNIs get a substantial lowering of income tax outgo by about 4%, they also must contend with four new proposals that may increase tax and cash outflow.